Hello everyone, welcome to Drishti IAS, and today we are here with another lecture of your revision with MCQs series for UPSC Prelims 2026, and today we are going to study the subject of economy with the help of various MCQs. So let's begin with the very first question, which says consider the following statements regarding insurance trends in India. One, from FY23 to FY24, insurance penetration showed an increasing trend, and the second statement says between FY23 and FY24, insurance density displayed an increasing trend, reflecting higher per capita spending on insurance. Now here we can see that there are two concepts that come to the forefront, and these two concepts are insurance penetration and insurance density. Now students, what is insurance penetration? Basically, it is the insurance premium expressed in terms of or in percentage of GDP. So, insurance penetration is premium expressed as a percentage of GDP. What is understood by premium? What is insurance premium? It is the amount of money that you have to pay out to keep your insurance policy active. Now, this premium could be paid monthly or annually. Insurance penetration actually determines how deeply insurance is embedded in economy. How deeply insurance is embedded in economy. Now, it says that from FY23 to 24, insurance penetration showed an increasing trend. Now, this statement is factually inaccurate because during this period, even though the total insurance premiums were on the rise, however, the penetration or the premiums expressed in percentage GDP suffered from a mild decline. It was a mild decline. So, it declined from 4% earlier to 3.7% in FY24, and the decrease or this decline was mostly noted in the life insurance premium, where the decline was from 3% in FY23 to 2.8% in FY24, whereas the non-life insurance premium penetration remained steady at 1%. Now, the second statement says between FY23 and FY24, insurance density displayed an increasing trend. Now, first we need to understand what insurance density is. So, insurance density, students, is basically per capita premium. Per capita premium, and it is expressed usually in US dollars. So basically, if we consider the total premium and divide it by the total population, we arrive at premium insurance density. So the second statement is factually accurate because there has been a modest increase, a modest upward trend in the insurance density in FY23 to 24 from 92 US dollars in 23 to 95 US dollars in FY24. So this statement is correct, which gives us the right answer, option B, 2 only. Now let's take a look at the explanation. Please pause the video and take a look at it. Question 2, consider the following statements. 1, between FY11 and FY22, the share of banks in total credit displayed a declining trend, falling from nearly 3/4 of total credit to well below 2/3. Now, we are here talking about a given period, which is financial year 2011 and financial year 2022. And we are talking about the declining share of banks in total credit. So, first let's understand what is meant by total credit. So students, total credit is nothing but loans that are provided by banks, NBFCs and other financial institutions. So this statement is telling us that between this period, the share credit of banks in total credit has declined. Now this statement is accurate. Why? Because during FY11, the share of banks in total credit was approximately 77%, whereas in FY22, it declined to approximately 58%. Why? Why did it happen? Because the NBFCs started gaining a lot of prominence around this period. So because of the increasing prominence of NBFCs, the banks showed a declining trend. Second statement says, in FY24, India ranked first globally in terms of the number of IPO listings. Now, in FY24, a lot of Indian companies decided to raise money through IPO listings, which means they decided to raise money through stocks or shares. And it is correct that in FY24, India ranked first globally ahead of its competitors China and the US in terms of the number of IPO listings. Notice we are talking about the number of IPO listings, and India is not a leader here by value, just by number. Now this rise was driven by young investors and young entrepreneurs. So this statement is factually correct, and therefore we have option C as the correct answer, which says both 1 and 2 statements are correct. This is the explanation. Please pause the video and take a look at it. Question 3, consider the following statements regarding India's textile exports in 2023. Now, what is crucial to note before we look at these statements is that India's textile exports reached US dollars 34 billion in 2023, which is a very good amount. So let's take a look at the various statements that are given. 1. India's top textile exports remained heavily concentrated in cotton and cotton-based products. Now this statement is indeed accurate. Why? Because 8 out of 10 products in India's apparel or textile based export baskets are cotton and cotton based. So this statement is accurate. The second statement says India's global apparel market share was significantly lower than that of major competitors such as China, Bangladesh and Vietnam. Now, even though textiles does form a major chunk of Indian exports, despite that, India's global apparel market share at 2.8%, students, was far behind that of its competitors like China at 30%, Bangladesh at 9% and Vietnam at 7%. So this statement is again correct. The third statement says Europe and the United States together accounted for more than 50% share of India's apparel exports. Now, it is again a correct statement because Europe and the United States do absorb over 50% of India's apparel exports, out of which 66% is for apparels, 12% is for finished non-apparel goods, and 58% is for semi-finished or raw goods. So this is also correct. Now, there are other lead apparel export destinations for India like the UK and the UAE as well. So this statement is correct, and with this we arrive at the correct answer, which is option B, 1, 2 and 3. This is the explanation. Please take a look at it. Question 4, national income at factor cost is derived by which of the following adjustments to NNP at market price? So the question asks us if we had to arrive at national income at factor cost, what adjustments would we have to make at net national product at market price? We are dealing with two concepts, and the relation between them. So let's begin with how we can arrive at the relationship between these two concepts. Beginning first with GDP, or the gross domestic product. It is the total value of goods and services produced within the territory of a country within a given year. So it is basically goods produced within Indian borders, right? Or the money made within Indian borders. Then we have another concept of GNP, or gross national product. What does this mean? It simply means that we take GDP, we add all the money that the Indians residing abroad are making. So, income of Indians who are abroad, and we subtract that money which the foreigners living in India are making. So we minus income of foreigners in India, or earning in India. So we arrive at this concept of gross national product. Now from this gross national product, if I subtract depreciation or wear and tear, then I'll arrive at net national product. So gross national product minus depreciation. Depreciation meaning wear and tear will give me net national product. Now there are two ways to understand the net national product or measure the net national product. How? At market price or at factor cost. When I'm talking about the net national product at market price, it actually reflects what the consumer has to pay. So when the consumer pays something at market price, we can understand it as net national product is equal to NNP plus taxes minus subsidies. Because if you think from a consumer's point of view, the consumer does pay taxes but does not really receive any subsidies. But at the factor cost, NNP at factor cost becomes what? Income from all factors of production. What are the factors of production? Land, labor, capital and entrepreneurship. So what are the incomes from factors of production? They are rent, wages, interest and profit. Now net national income at factor cost is simply national income, which means national income at factor cost can be simply understood as national income. When we are talking about factor cost, we are talking from the perspective of this, from the factors of production, whatever goes into production. So here what will we do? Here at this market price, net national income, net national product at market price, we are here going to minus indirect taxes, because here indirect taxes are paid by the consumer. So it is not included, but we will include subsidies, because subsidies are paid to the factors of production by the government. So if we subtract indirect taxes and we add subsidies to the net national product at market price, we are going to arrive at national income at factor cost, simply national income. So with this, let's take a look at what the option says. Here option C says subtracting indirect taxes and adding subsidies. So we arrive at the correct answer. National income at factor cost, simply national income is equal to NNP at market price minus what exactly? Indirect taxes plus subsidies. And with this, we have arrived at the correct answer. Here is the explanation. You may pause the video and take a look at it. Next question, consider the following components. How many of the above are not included while measuring core inflation in India? So there are a few things that are given and you're asked to figure out how many of them are not included in the core inflation, in the measurement of core inflation. So first, let's try and understand what core inflation means. Core inflation refers to that inflation which remains steady over a period of time, which does not fluctuate or is non-volatile. So, it remains steady, does not fluctuate and is non-volatile. Now, how do we arrive at core inflation? We arrive at core inflation by taking out certain items whose price fluctuate very often from the headline inflation. Now, there is another concept of headline inflation, which is the inflation that is talked about, the numbers that are in the news all about, and it is also based on CPI, Consumer Price Index, that we are going to read about in the upcoming questions. So, this headline inflation consists of various components, food, non-food, etc. Out of which, if we remove the volatile components, we arrive at core inflation. Now, a way to understand is, just like the headlines, the news headlines keep changing every day. Therefore, headline inflation also keeps changing every day because it consists of different kinds of components. Whereas, just like core remains steady, core does not fluctuate. Similarly, core inflation remains steady. That does not mean there is not a change in inflation. It's just not very volatile. All right. So, usually out of any given basket, food and fuel are considered to be very volatile because their price fluctuates very often. So, this is never included while measuring core inflation. Whereas these two, clothing and woodwear as well as manufactured goods, tend to have a stable inflation rate, and therefore these are considered in core inflation. With this, we arrive at the correct answer, which is option A, only 2. Now here is the explanation, and you can see that by their very nature, food and fuel have been highly volatile, and therefore we arrive at core inflation by removing food and fuel components from the headline inflation. All right, and therefore option A is the correct answer. Now again, we have the 6th question. Engel's law represents the relationship between. Now first, understand who is Engel and what is his law about. So Ernst Engel was basically a German economist and statistician. And what he did was, he studied various Belgian households. He studied Belgian households across socio-economic sections of the society. So across different strata of the society, he studied various households and arrived at certain observations. So his observation was that as the level of income in a household rises, the share or proportion of spending on food decreases. Notice that I'm not saying here that the spending on food decreases. I'm simply saying that the share of that spending out of their total income on food decreases. Meaning, let's say that if a household was making rupees 10,000 earlier, Engel observed that around, let's say, 5,000 of that money was being spent on food. Whereas when their income rose to, let's say, 50,000, then the spending increased to 10,000. Now in absolute numbers, the spending went up by 5,000. But in terms of their share, it remained only 20% as opposed to 50% that it was earlier. So we can say that Engels' law represents the relation between income and expenditure, and therefore option B is the correct answer. Please take a look at the explanation and pause the video. Question 7 says Consumer Price Index CPI is used as a tool for which of the following? Now here we discuss CPI very shortly. So CPI or Consumer Price Index is basically a tool used by the RBI, the tool used by the government to measure the average increase in prices of goods and services. Now, earlier what used to happen was that this CPI was presented only for a specific section or specific groups of people. For example, it was given out for industrial workers or agricultural laborers and so on. But then the government recently divided or brought out this CPI for two major categories, that is CPI urban and CPI rural. The CPI urban talks about the entire urban area, the inflation of the entire urban area, and the rural one about the entire rural area. Now, what is the function of this CPI? It is used for various purposes. For example, inflation targeting by the RBI. This is accurate. The inflation that is targeted by the RBI is actually the CPI. Then indexation of dearness allowance. So your DA and your salaries and pensions are determined by the government on the basis of this CPI. Measuring headline inflation. Absolutely. Your headline inflation is based on the CPI. And then fourth, deflator for national accounts. This is also accurate. The MOSPI does mention that CPI is used as a deflator for various national accounts. So here we have all the four as the correct answer. You may pause the video to read the explanation. Now, it is important to note that the CPI is published by the Central Statistics Office or the CEO, and the term headline inflation refers to inflation measured using the comprehensive CPI, and therefore option D is the correct answer. Question 8 says consider the following statements regarding the impact of an increase in the repo rate. We are talking about an increase in the repo rate. What is the repo rate? Repo rate is actually a repurchase agreement. In simple words, it is the rate at which RBI lends to commercial banks. The rate at which RBI lends money to commercial bank. Now, a situation has been given to us where the RBI has increased the repo rate, and we have been given certain possibilities, certain scenarios, and we have to figure whether this is going to happen or not. So the first one says higher borrowing costs for commercial banks, and we are going to proceed very logically from here. Now the RBI has increased the rates at which commercial banks may borrow from them, from the RBI. So indeed, the borrowing cost is going to be higher. So this is accurate. The second option says expensive monthly EMIs. Now, if I as a commercial bank, I'm getting loans from RBI at a higher price, I'm also going to relate to my customer, to my clientele, and obviously they'll have to give monthly EMIs at a higher cost, and therefore this is accurate. The third option says higher consumption. Now, if borrowing is going to be more difficult for me, If borrowing becomes more expensive, then my spending is naturally going to go down, and therefore this should be lower, and this option is incorrect. Fourth says higher investment. Now let's take a look at higher investment. The cost of capital is rising. The cost of capital is high. Then naturally, as an investor, I am not going to be very enthusiastic. All right. So this again is incorrect. The investment is supposed to go down. So here we arrive at the correct answer, which is option B, only 2. Question number 9. Consider the following statements regarding the marginal standing facility, or the MSF. Now, marginal standing facility is a short-term facility which is a part of the liquidity adjustment facility of the RBI. Meaning, the RBI facilitates overnight loans, short-term loans to scheduled commercial banks in case of liquidity shortages. Now, there are certain conditions. So, in case of MSF, these are basically overnight borrowings by scheduled commercial banks only. Only scheduled commercial banks can borrow this money from the RBI. Against what? Against securities. And it is capped at 2% of their net demand and time liabilities. Net demand and time liabilities are basically the sum of their demand deposits plus time deposits minus certain interbank adjustments. So your demand deposits like savings accounts, current accounts, and your time deposits like your FD, RD, etc., the sum of these minus some adjustments amount to net demand and time liabilities of a bank, and your MSF has a capping of 2%, meaning if your NDTL is 100 crores, you can only borrow up to rupees 2 crores overnight from the RBI, and usually you can borrow this at a price which is around 25 basis points higher than the repo rate. Why? Because it is a penal rate. It is a penalty that you have to pay. With this background, let's look at the first statement under the MSF. Scheduled commercial banks can borrow funds overnight from the RBI against government securities. So this statement is accurate. Second, the MSF rate is typically fixed around 100 basis points. Wrong. Lower than the repo rate. No, I told you this is a penal rate, so it is higher. To encourage banks to borrow during liquidity shortages. So this statement is inaccurate. With this, we arrive at the correct answer, which is option A. Now here is the explanation for you. Please pause the video and take a look at it. Question 10, the final question. Consider the following statements regarding the National Small Savings Fund, NSSF. Now, before considering these statements, let's first understand what the NSSF or the National Small Savings Fund is all about. Now, this fund is basically a fund where money from all these small savings schemes like your post office savings, your national savings certificate, etc., is collectively pooled in this fund. And this fund is created within the Public Account of India. Public Account of India. This fund was created in 1999. And of course, it was created, the rules were issued by the President under Article 283, Clause 1 of the Constitution. Now, the first statement says the National Small Savings Fund is administered by the Ministry of Finance, Department of Economic Affairs. This is accurate. This is actually the case with this fund. The second statement says the primary objective of the NSSF is to de-link small savings transactions from the Consolidated Fund of India. This is also accurate. It was created within the Public Accounts of India in order to de-link the transactions from the Consolidated Fund of India so that this small savings fund can run in a transparent and self-sustaining manner. Therefore, option 2 is, or statement 2 is also accurate. The third statement says under the NSSF mechanism, the entire gross small savings collection is directly invested in the special securities of central and state government. Now here is the catch. No, not the entire gross small savings collection is invested, but rather the net small savings collection, meaning that after withdrawals and outflows, whatever remains is actually invested in these special securities of the central and the state governments. Now, the interest that is received from these securities amounts to the income of the National Small Saving Fund, and the interest payout that is made to the subscribers, the small saving subscribers, along with administrative costs amounts to the total expenditure of the fund. So here we have 1 and 2 statements correct and 3 wrong. Therefore, option A is the correct answer. You may take a look at the explanation. Now I have brought to you a practice question. Please take a look at this and do send me your answers in the comment section. If you found today's video beneficial, fruitful or useful in any way, please like, share and subscribe. Thanks for watching.
For more informative content, like, share and subscribe, and do not forget to press the bell icon to get the notifications.